While investors' flight to quality pushed down the average prices of some lower-rated leveraged loans. In fact, Goldman Sachs' co-CIO, Anish Shah, says, well, pockets of value in riskier debt are actually still there. He wrote, "We are starting to find opportunities where we are willing to go down in quality. We think the market is being too bearish on the economy, and we are finding good value in mid-quality high yield." Bob Miller, Krishna Memani of Invesco, and James Athey are still with me. Bob Miller of Blackrock, you were nodding there. What does that mean, mid-quality?
So I think the really several interesting observations in the credit market this year, but the primary one is the degree to which the up in quality trade has worked, right? The single A, double A CLO versus double B, single B mezz tranches. They've had this massive widening up in quality. In high yield, this will be the first year in over 2 decades where the high yield index returns over 7% and triple C's underperform double B's. That typically only happens when the index is a negative return. So you've had this big dispersion, right? Decompression rally. And the question going forward is, back to the original question you asked at the start of the show, is what's the growth outlook? Because it strikes me that this up in quality trade is reasonably mature, and that if growth is better than expected, if we actually get some real reacceleration, then the bottom of the capital structure is going to start to perform. It's going to catch up. And if growth actually turns out to be worse than expected, then you're going to start to see some of the weakness in anticipated cash flows creep into the higher quality part. So we're at that inflection point. As I said, I think we're probably going to soft land here. The risk is that we don't, but if we do soft land, there is some value down the capital structure.
And here we can see, we want to show you what's happening in terms of triple C's versus double B credit, because really, as to your point, we are starting to see the double B, the better asset quality, doing better than the triple C. Do you fade this, Krishna? Because I mean, if the Fed is there, if monetary policy is there, why not go riskier?
So a couple of observations again. One of the reasons why the higher quality end of the credit market has done well is because it has more interest rate sensitivity. So as interest rates have rallied, triple C's, you're buying for recovery rather than for interest rates. So I think that if you strip that out, the up in quality trade has worked because the economy has slowed down. But the magnitude of that working is probably not as large, minus the interest rate rally.
I see.
So that's point one. Second, I think if there, Ashish is right. If there is, I think people are being extraordinarily conservative with respect to the economic outlook. If the expectations turn at any point, I think the parts of the market that are being left behind is where people are will probably gravitate towards. And one of the reasons why they would gravitate towards that was because rates would be rising in that environment. And the interest rate sensitivity of that part of the market probably is not going to be as large as it would be for double B's and triple B's.
Let's get out to our British bear, because James, I mean, your perspective, if we're not going to see the fundamentals improve, what then is it still a flight to the safer havens within credit quality? Is it sticking to double B's rather than triple C's?
Yeah, I mean, you do occasionally get these perverse situations, however, where because of the nature of how people have positioned going into, presuming that we are heading into a slowing growth environment or even a recession, actually people have already positioned in terms of that quality spread that you've just described, and they're still forced to sell because their underlying clients, for example, choose to sell units, and therefore you can actually find that the higher quality stuff performs just as badly or not, or even worse. We saw that with AAA mortgages in sort of 2008 and 9. So to me, what we're seeing in terms of the spread of performance between high quality and low quality, notwithstanding I agree with Krishna about the duration aspect, it really is, it's telling you something about sentiment and the practicalities of credit markets. You don't feel particularly bullish, but you can't sell out entirely out of the asset class, and we're seeing the same thing in equities, which doesn't suffer with the same liquidity problem, but it's a way of being cautious without completely selling out of an asset class which you might struggle to get back in because of liquidity concerns.
I like that you bring up the practicalities of the credit market and what equities tell us versus bonds, because here's a great chart showing you that basically, in some ways, the credit market is working exactly as it should. PG&E, we're at 115 in terms of where the bonds prices are trading because the equity is taking the hit. The equity story is the demise. Bonds are going to be paid back. On the blue line there is WeWork. WeWork now trading at 83% of face value in terms of its bond prices. Finally, it seemed as though they decided to move against where perhaps the VC enthusiasm was and decided to actually get the picture that this is a company that doesn't own any assets, Bob, and maybe at risk. Clearly, when we're talking about an $8 billion valuation and we work rather than $47 billion, moving aside from the individual case of this particular company, are we starting to see a movement of particularly these sorts of unicorns and riskier companies deciding that actually we need to show profit rather than just growth at all expense?
Yeah, I think the market is raising its required return expectation in order to continue funding a number of different business models. And you see this again in the CLO space. The weakness in the triple B, double B part of the CLO this year isn't it's not sector specific. It's very idiosyncratic. It's poor business models or poorly structured CLOs or where the documentation is not particularly investor friendly. You're seeing those types of weaknesses, which are kind of late cycle phenomena, right? And I think that's consistent with where we are.